Bob's a new face, obviously, for many of you. So as he mentioned, he's our COO. We brought Bob on back in May, and Bob is a little bit of a tornado at the office, in that Chris has a lot of ideas, and Bob just starts spinning around and getting stuff done. And hopefully, you're going to start seeing a lot of that go on. The one thing I'm going to encourage you real quick with everything with him is if there's something that we can be doing better, communicate that to Bob, not me. Not because I don't care, but if you communicate to me, I'm going to give it to Bob. So I want to give you direct access to Bob. Anyhow, Jacob, good to see you.
Good to see you.
All right. Hey, everybody, good to see you as well. We are going to dig into the market today and really try and put some perspective as to what's going on. Hopefully, all of you have been getting regular emails from us on a weekly basis where we do a Wealthologist update, where usually it's a video audio of markets or some sort of financial planning. But once a month, what we've been doing for the past year is Jacob and I have been doing the Wealthologist Live. And this is where we're trying to just do a bit of a quick market recap, give you a bit of an update, a little bit of our perspective as to what's going on. As always, I encourage you to ask any questions that you might have when we have things like that. And even today, if time permits, and some of you have questions, we're more than happy to take some questions and open up the floor for some questions or for some clarity. But today is just kind of an extended version of that. An extended version where Jacob and I are going to dig into what's going on and go from there. Now, if you ever watch Wealthologist Live, I always start with a crazy Chris story. So in talking with somebody in the audience today, I had mentioned a story that not many of you know about. That's just kind of a fun fact about Chris's history, which is when I was 23 years old, I lived in a retirement home. Anybody know that about me? Now, I mention that because it was probably the coolest experience I have ever had in my life. At the time, I worked for a company that moved me out to San Francisco, California. I worked for a technology company, and it was right when the markets were crashing. You all remember that, the dot-com world? It's right when that was happening, and the company I worked with, they paid for my housing until the markets crashed, and they said, Chris, we got to go someplace cheap. And I said, oh no. And they gave me the budget, and I said, oh no. And a buddy of mine worked at a retirement home, smack dab in the middle of San Francisco. And I said, Peter, is there any chance you've got some openings? He said, we do, but we don't have 23-year-olds living here, Chris. Our minimum age is around 75 years old. I said, maybe they'll let me in just for a while. So for 2 months of my life, I got a chance to live at a retirement home, which gave me a much different perspective. And I think it's been something that I've been able to pull in a lot of different conversations or have a different understanding. But probably one of my favorite things that I used to do was I used to go down for lunch every day and hang out and actually have lunch with folks until the management of the retirement community came up to me and said, Chris, you're not spending enough time with everybody. We've had some people complain that they want to be with the young guy. It was, now if I went there and they saw my wet hair, I'd no longer be the young guy. Anyhow, just a fun story to kind of get us warmed up. But Jacob, I guess we got to start talking a little bit about what's going on in the market. Real quick, as you all know, our compliance officer at the firm has all of these nice compliance-y type things. He's approved our presentation, and he's told us not to go off script, but if you know anything about Jacob and I, we might go off script. So today, really what we're going to focus on is covering 4 key areas. And as we talk about those areas, we're going to do a little bit of a backwards look, which is, what happened in 2023, and really, what drove that market performance? Because as we were talking a little bit before, the market in 2023 wasn't expected to do well. Pretty much most, if not all, analysts were sitting there saying, man, that's a mistake. And it actually did significantly better. And that's going to flavor a little bit about looking forward as well. Because now we're going to say, where are we now? We're 2 months into the year. Things have changed a little bit. If you watched my Wealthologist last night that came out, talked a little bit about what's going on with the Fed, some changes that went on there. Then we're going to look forward to 2024 and see what happens there. You guys ready? That's why you're here, so you better be excited. If you're not excited, this is going to be one long afternoon. All right, so Jacob, I'm going to give you the control because I'm going to let you drive. But we're going to start off with really that backwards look, which is what happened with the market. Now, I know you've got a way to introduce us into that, so I'm going to go ahead and tell you, I know the next slide. This is probably the best slide of the entire presentation, so pay attention.
Thanks, Chris. Thanks, Chris. Good to be here, guys. So my wife and I, we and our son Caden took a trip, I guess it was 2 weeks ago, to upstate New York of all places. And what's interesting about that trip is going into the trip, and I think I've got some pictures here that Chris has brought. So my unashamed plug of our son Caden. But as we were planning this trip to upstate New York, our desire really was to fly. We said, you know what, this is a 10-plus hour drive if we drive, but we really don't have any desire to drive, so let's try to fly. Well, long story short, the timing of the flights and when we wanted to get on the road just didn't add up, and so we decided to drive. And I can kind of chuckle about this now, but as my wife and I were planning, we kind of sat there and said, okay, we really want to just knock this trip out in one day. So 11-plus hour trip, let's just get this thing done, get up with family, and be on with our lives. Well, our 8-month-old thought differently, and we did not end up doing the trip in one day. We did it in two, we stayed halfway, and it actually worked out okay for all of us. But I think that the important point of this story for me is that what we expected with our trip was totally different than what the actual outcome was. And as I was preparing for our discussion today and our presentation, it reminded me of how similar the beginning of 2023 was from a market expectation standpoint to our trip. So let's dig in. I think this slide actually does a great job of illustrating how, again, analysts, the firm's expectations of the market at the end of 2022, how it actually panned out. And we can see the group average was right around 3,800 for the S&P 500. That was where everyone expected at the end of last year for the market to land. Well, we know now where the markets ended up, but we can see on the slide that we actually ended just shy of 4,800 at the end of the year for the S&P 500. Now, for those who are in the numbers, I am, that ended up being an annualized return of almost, or actually a little over 24% for the S&P.
Now, back it up just real quick, because I do think this is important. I want you guys to look at the names associated with these guesstimates, right? We're looking at Morgan Stanley, UBS, Wells Fargo, Bank of America, RBC, Goldman Sachs. By any stretch of the imagination, when it comes to the amount of money spent on analysts, economists, and everybody that has the fanciest of fancy degrees, that's a pretty good pedigree list, right? I point that out because at the start of the year, actually it's at the end of the prior year, they always go to these firms and they say, where are we going to be in a year? And the news media loves to kind of hang on this and say, my goodness, we got a plan according, got a plan according, got a plan according. And this is a case where pretty much everybody took a swing and missed significantly. And I think our next section, which is going to be talking a little bit about what drove that, again, we were talking about this beforehand. Last year, the expectation was more or less that we were going to be going into some form of a recession, and you could even argue that we experienced some aspects of a recession by typical definition. But instead, what we saw was everybody predicting slow growth, no growth, even growth, a recession, and pretty good returns happened.
Yeah, and I think to pull on that thread a little bit, I do want to talk, and this next slide helps us kind of set the table for what drove performance. And what is so interesting is we can see, this is a slide of the S&P 500. So we talked about it was up a little over 24% on the year. Well, this is just plotting the graph of how the market ended up and what it did last year. So we can see, there are a few themes that you'll hear us talking about today in this presentation. A lot of that will revolve around the Fed. A lot of it will revolve around interest rates, which of course, is determined by the Fed. And, kind of a byproduct as well, inflation, of course, is another theme that you'll hear us talk about. So when we look at this slide, there's a couple highlights that I wanted to make. And what's interesting is in the beginning of the year, we knew the Fed was still increasing interest rates. And so, in the February timeframe, we saw a 0.25% increase. As we got to the middle part of the year, we saw inflation hit a 2-year low. And that was a really positive sign last year. We got to past summer into the fall time frame. I call it kind of the fall doldrums, if you will. We saw some consolidation and some retracement, some pullback in the market. But at that time, towards October, that was where we saw the Treasury markets and the U.S. 10-year Treasury yield hit its highest yield, which was right at almost 5%. From there on, we saw a really nice rally to finish out the year, and a big part of that rally was really driven primarily by the Fed then coming out and saying, okay, we're forecasting interest rate cuts as we get into 2024, which I will say that is something we've talked a lot about, when we think the Fed will cut rates, and it's not something that surprised us. It is something we were expecting. But I did want to take just a second to talk just a little bit about the Fed interest rates, because I think we talk about the Fed interest rates all the time, and I think we sometimes assume that everybody else knows and fully understands. And so you may be asking the question, well, okay, I get that, but what is the Fed making these decisions, and when they decide to do something with interest rates, how does that play into the market and the economy? And I have a story or an analogy, a way that I like to think about this, and I've talked a little bit about it before, so hopefully it isn't too new news for you, but we all know the board game Monopoly, right? So everybody, I think, understands how Monopoly is played, or at least I'm going to make the assumption that we all know. And the way that I like to think about that board game, we know there's a banker, right, in the board game, and they control the money on the board game. Well, if we were to imagine the banker, let's imagine the banker as the Fed, and let's say, okay, the banker says, we're going to change the rules, and instead of passing go and getting $200, we're not going to give you $200. So you're not getting $200 every time you pass go. Well, the impact of that to the game, as we can all imagine, is that there's less money in the pockets of the players, and the impact that has on the board game is likely we're not probably seeing the players bidding up the prices of the property as much, or the asset prices, right? So the park places and the boardwalks. On the flip side, if the banker, or in our case the Fed, were to say, okay, we're changing the rules again, and instead of passing go and getting $200, we're actually going to give you $400. So lucky us, we get more money, and the dynamic that has in the board game or in the economy is that there's more money in our pockets, more money in the market participants, and likely we're probably going to see the property prices or the asset prices bidded up, again, against the park places and the boardwalks. So that's a way that I like to think about how the Fed works and operates in the economy and the markets. It's an interesting way to think about it, but I think it does help us when we're looking at money supply and then what impact does that have, on asset prices ultimately.
And actually, in my in the Wealthologist that I did that went out yesterday, I talked about the money supply, what's called M2, and the M2 money supply. Basically, when we look at that, that's how much new money is pumped into the system. And if we look back at 2008, 2009, when we went through that kind of Great Recession, I guess they called it. What happened was we didn't have a real big, or we had different adjustments within the economy, money supply being one of those. But in 2020, 2021, through the whole pandemic scenario, we increased our money supply by about 40%. So you couple 40% increase in money supply along with low interest rates for as long as we had them, it leads to a lot of the things that we're seeing right now with the Fed. Inflation being a big driver. Yep. And again, an increase in money supply to the level that we saw it back in 2024. I mean, that's a big number to see 40% increase in what's been.
And we'll talk a little bit more about that too, because we've got a slide that points to that as well. This next slide, I'm not going to spend a ton of time on this, but this is just a measure of earnings, or if you think about it, income that companies derive from their business operations, but it's measuring the S&P 500. And the point that I would make to this slide is focusing on the years of 2022, 2023. This is just a measure of quarterly earnings changes. And the highlight from this slide really is just that starting in 2022, we were in what we would call a mild earnings recession because we had 3 consecutive quarters of declining interest rates. You can see, though, we bottomed out beginning of 2023, kind of middle of 2023, and then the third quarter of last year, we saw a really nice increase in the change in quarterly earnings. That was a big reason why we saw, one of the big reasons why we saw an increase in the market towards the end of last year, the fourth quarter of last year. Now, we do need to spend a little bit of time on the economy last year. Again, we're talking right now about what drove performance, what drove the 24% return. And I'm not going to belabor this slide because there's a lot of data, but 3 things that we want to talk about are GDP growth, the unemployment rate, and then of course inflation. We all know what inflation is. I'm not going to dig into that too much, but the key point with this slide is that throughout last year we saw a decline in inflation. That was good for the markets. The unemployment rate, that's just the jobs market, and so you've all probably heard on the news and through your readings that we've all been talking about the resiliency of the labor market. That just means that the jobs market has been really strong, and that's a big reason why that trickles down into the economy, into the markets, and it has been a strong point or a strong reason why we saw such good growth and did not go into a recession last year. And then the last point, GDP growth. So just to break that down, GDP stands for gross domestic product. And it's the definition of GDP is just the amount of goods and services that we're producing in the economy in a given period of time, year, quarter, whatever the measurement period is. But it's very important. So I like to think of GDP, I call it the lifeblood of the economy. It's very important. If you think about our bodies, we all have blood in the body, and we have to have blood and keep blood in the body. If we don't have it, we're not going to sustain ourselves. And that's the same way that I think about GDP growth, being that we've got to have it to sustain the economy, but also to grow as well.
I want to add a quick point too, because I think sometimes this can be one of those confusing things. Because you had mentioned decreasing inflation, and sometimes when you hear decreasing inflation, you think that prices are going down, and that's where we just want to make sure that there's not confusion between decreasing inflation versus deflation. So deflation is when prices actually go down or drop. I don't know if you guys have been to the grocery store. We are not experiencing deflation. Rather, when he talks about decreasing inflation, it just means that the rate of price increases is slowing down. We, at one point, about a year and a half ago, we were year over year, what was it, 14?
Not quite that.
Not quite, but I mean, it was, maybe I'm compounding.
Yeah.
But it was crazy. And what we're seeing is that prices are still going up, but it's just at a slower rate.
The term I should have used was disinflation, which is, to your point, a decreasing rate.
But it's still confusing one or another. I just don't want people sitting there saying, well, why haven't I seen lower prices at the grocery store? And just to be clear, we're not expecting deflation anytime soon. Again, with massive amounts of money going into the system. In fact, we were just talking about somebody selling their house. How many of you in here in the past year and a half have sold your house? Okay, a number of you. How many of you sold it above asking price? Okay, I see a couple of hands going up as well. And again, that's crazy.
It is.
To think that, again, in the conversation that I had, somebody listed their house on a Friday, on a Monday they had, their house was sold above asking price. Again, Nick, I know you experienced the same type of thing. Or if you've gone to buy a house, you've experienced the same type of scenario. Hopefully, as inflation slows down, we're not going to see that quite as much. Unless you're selling a house, then you're sitting there saying, keep that happening every day of the week. Quick question?
I have a quick question. I have heard that inflation, one of the biggest contributors to inflation is the cost of oil. Because everything we buy has to be transported somewhere. And so is that something that y'all agree with? And would there be a chance that prices could actually inflate? Not deflate, but I mean, or get lower if the oil would go down and
so costs of ancillary costs will always drive price, right? So if we have a cost like oil, it's gonna be a factor inside our pricing. The only thing that I would say is that's a piece of the puzzle, not the entire puzzle. And while oil can be very, very, very important and impactful, I don't think it's the full story. And I would argue that the inflation that we're feeling right now is we literally just pumped in so much money into the working economy to solve the whole issue that we had in 2020, 2021, and so on and so forth, that now we're dealing with the ramifications of that. So I would say right now, the bigger push, and you may have a different perspective, is probably more on the amount of money that we just, quite frankly, we just printed. And we kept printing and printing and printing.
Well, like building houses, the cost of wood has gone through the roof.
Yep.
And things like that. And it's not because there's not any wood. I think there is wood, but it's just trying to get it from one end to the other.
Well, there's transportation, but there is supply and demand. So if we think about that, when we have a huge demand for wood, so you're right, if we go around the world, I believe actually the United States right now has more trees, like actually live living trees, than we had like 200 some odd years ago. Which is kind of crazy to think about because we always are told we don't have enough trees, but we actually have a lot of trees. So we've got a lot of supply, but it's not necessarily accessible supply. And what's accessible, when 2020 hit and everybody said, well, I'm staying in my house and I'm fixing stuff up, people just started basically taking all the supply that existed and it wasn't being replenished at that same level. What's a good business to do? Well, geez, we don't have that much supply. People want it. We're going to increase pricing accordingly. Again, oil works the same way. But I think that's a great point. There's a great book. It's an old book. I can't think of the name of it, but it is the story of how a pencil is made and all of the pieces that. Has anybody read? No. It's a great story about how a pencil is made and how you look at this simple stick with lead in it or graphite in it as it is inside of it, and you think, oh, this is pretty simple. But they go through everything that it actually takes to make a pencil, and it will astound you. I suggest Googling that. I think, again, how a pencil is made is going to be perfect. Google, I wish I knew what that was off the top of my head. But to your point, it talks about all the pieces that make oil is a big piece of the pencil, not just in transportation, but in paint production and things like that.
I agree.
And the other thing too is why do not everybody in the whole world have to buy a hybrid car? I mean, when you have the oil, it wouldn't hurt the climate too. But yet you don't hear anything about hybrid cars anymore. Now it's just electric cars. But hybrids are charging when they're using the oil, but they're not using the half of the oil that other cars use. I wonder why we haven't had any kind of emphasis on that.
Well,
it's a great question.
it is. I mean, it's one of those things where I think we got to be a little bit careful because that is kind of like that mandate thing. It's like the government saying we got to do that, and it's very possible. I do think that the government has come out and said by 2050 we've got to have a certain number of all electric cars. So I mean, I think we are seeing moves towards that speed to that. The reality is, fuel is very efficient and cost effective, and the whole world is built around it. So it's going to be one of those tough things to do too big of a shift. And I think until some of that gets a little bit more efficient, because there are impacts as well when we're talking about hybrid or electric cars. Lithium is a very big impact on them. But maybe we can talk about it. We can dig a little bit deeper. No, I appreciate the questions. I just want to make sure that we're hitting our time schedule as well. So where are we now?
Let's talk about where we're at.
Where are we now?
Let's talk about where we're at.
So, I love these, I got to tell you. So whenever we go through talking about what to put in presentations, Jacob and I we don't battle on this, but Jacob's like, man, that is just so much information. And I'm like, man, that's just so much information. Jacob likes the numbers, I like pretty pictures. So I think that's the deal.
Match made in heaven.
Exactly. So go ahead.
Yeah, so kind of break this down a little bit, because there is a lot of information here, but I think the key with this slide is, first of all, looking at these different, what I call spinometers, right? And what they're representing are different economic indicators. And a couple of the indicators that I think are important to mention, I'm looking at the slide here, but the top left, monetary policy. If we go all the way down to the bottom left, we can see inflation. Each of these economic indicators can be positive, can be neutral, or can be negative, depending on where we're at in the environment. And they tend to forecast about 3 to 6 months into the future for the market environment. Now, this is a snapshot of November 2020. Let's think back to November of 2020. We were just coming out of the pandemic. And to Chris's point earlier about all of the money creation during that period of time, if you remember, we were literally getting checks into our checking account or direct deposits into our checking accounts because of the stimulus that the government was handing out. That points to that speedometer up on the top left, the monetary policy being positive for the markets at that point in time because we were creating all this money. Again, think back to the example of the banker in the game of Monopoly. That environment, what was occurring then was the same as the banker saying, okay, instead of getting $200 for pass and go, we're getting 400. So there was more money in the system or in the game, and that was a big reason why we saw the markets perform like they did. Interestingly enough, inflation was also saying positive, so meaning it was not a concern at that time. It should have been positive for the markets. And at that point in time, it wasn't a concern. But again, hindsight being 2020, now we know that it ended up being a concern because of all the money creation. Now, if we move on, now we're looking at December of 2022, and this is a completely different picture. So I would describe this slide as a lot of red on the board, right? There's a lot of those speedometers showing negative, some caution as well. But we see that monetary policy now at this point in time, we've just gone through, if we remember, we've just gone through a lot of interest rate increases. So monetary policy is saying negative, saying red and bad impact for the markets. Inflation also starting to turn, we're not all the way into the red at that point. But I think this slide provides a lot of context because as we were looking at the first slide, where all the analysts were predicting where markets could go, this would have been the absolute worst time in the world to have said, oh, I'm going to go more conservative, or I want to adjust or go to cash, because from here, we had a great run in the markets. And again, this just, I think, in my opinion, speaks to a disciplined, consistent investment approach, which we'll talk a little bit more as we move along. Now, this slide here is just showing us kind of a current snapshot, so last month of this year. And I think the word that probably best describes this slide, in my opinion, is one of caution. There's a lot of neutral, a lot of just yellow there on the board. I mean, there are a few that are red, but most of this is saying caution. And it speaks to our base case scenario for this year, which we'll talk a little bit about as we move forward in the presentation, which is where we think things are headed. We feel that kind of that cautiously optimistic approach for this year is appropriate. Part of that has to do with this being the year of presidential election, and we'll talk further about that as well. But to me, this slide really sums up just a word of caution as we're moving forward into this year. Now let's talk a little bit about headwinds. As this picture portrays, I just want to break down real quick what a headwind is. If you see the picture, if you can't tell what that is, it's a paper airplane, right? So if you think of putting a paper airplane together and throwing it, well, you can see that if there's wind coming at the nose of the plane, preventing it from going where it needs to go, that's a headwind. So a headwind, just think of it as not being necessarily good for market growth. And there's a lot of headwinds out there that we can talk about. We're not going to talk about all of them today. But when I look at inflation is definitely a potential headwind. We're expecting inflation to continue to moderate, and to Chris's point, moderate at the pace of its rate of change. But if inflation were to reverse course and go up or not reduce as much as we expect it to, I think that's definitely a headwind for the market. Fed policy, that's another big one. I mentioned we're going to talk about the Fed a lot today, but what the Fed does is very important. It drives the market. And so if the Fed were to say, taking a half step back, we know the Fed is looking to cut interest rates this year. If they were to say, well, we're not going to cut rates. We're going to keep them where they're at, or we're going to actually increase rates. That's definitely going to be likely a headwind for the market. And again, 2024 election year, we've got that coming up. I think the one area that I wanted to point out from this slide with the election is that history would tell us the first 6 months, typically give or take, in the year of a presidential election, the analysis and the data shows that a lot of times we see some consolidation and some weakness, which means, we've seen a good run, but we could see some pullback, we could see some choppiness in the market as we move into the second half, or the first half of this year. But as we move into the second half, and you'll see on the next slide, we actually think that it could be a headwind, or a tailwind, I should say, for the markets. So let's talk a little bit about the tailwinds. Again, you can see from that picture that tailwind is good for the market because you got that paper airplane, you've thrown it, and you've got the wind behind it that is impactful in getting us to where we need to go quicker. As I mentioned earlier, I think moderating inflation would be good for the markets if we were to continue to see inflation reducing. We've got up here a dovish Fed, and I want to break that down for just a second because that's a pretty technical term. What that means, and an example of a dovish Fed is just, again, we know rates are likely to be reduced about 0.75% to 1% this year. Well, if the Fed were to say, we're actually going to drop rates more than that, we're going to decrease rates by 1.5%. That's an example of a more dovish Fed. If they were to come out and say we're going to decrease rates sooner than what we thought, right now our base case is probably middle of this year when they cut rates. If they were to come out and say, we're going to cut them next month in March, that's likely, that's an example of a dovish Fed that likely would be really good for the markets. Again, think of that banker analogy in the game of Monopoly. It's the same example of the banker saying, all right, you're getting $400 for pass and go instead of the $200. Lastly, we've got the election listed as a tailwind, as I mentioned. I think as we move into the second half of this year, the data and the research shows that gives us a pretty good indication that we could possibly see a rally as we move into the second half of the year. Part of that's because a lot of the election uncertainty has kind of subsided and there's more certainty in the markets, which the markets like that certainty. All right, so we're going to talk about the forecast. Before we get into the actual forecast, I want to just share a couple more slides. I touched on this earlier, so we're not going to spend too much time on this, but this just reiterates the point that the earnings of the S&P bottomed out last year, and now we are expecting growth in earnings as we move into 2024 and 2025, which should bode well for the markets.
What do we see as, from your perspective, as some of the reasons why we saw those compressed earnings?
Yeah. A big reason, one of the reasons we saw compressed earnings was inflation, right? Some companies do better at passing on higher costs to their customers than others, but increasing costs, increased costs for us as consumers, but also an increased cost for businesses. And sometimes businesses aren't able to pass those costs on to the consumers. So that was one of the big reasons why we saw earnings falling. There were a few other reasons as well. I don't want to go too far into the weeds with that, but inflation was a big driver. All right, so we talked about GDP growth already, and we talked about jobs. Now, from this slide, we had a number of economic forecasters that were surveyed by the Philadelphia Fed, and they came up with these growth projections. And I think the key takeaway from this slide really is just showing that we're not expecting growth to be as good this year as it was last year. So again, we had a really good year from a growth perspective last year, not expecting growth to be as good. We still are expecting growth, and that's important to point. And the other thing that I'll make a point of is we're also not expecting this huge, large economic recession. There is a chance as we move further into the year, and again, we want to monitor the labor market and monitor growth, that we could move into an environment that's not as conducive. But this chart shows that we're expecting slowing growth, but again, not forecasting this large economic recession. I will say too, the jobs market is important to pay attention to. So if jobs were to weaken dramatically, more dramatically than what we're forecasting, that would be something to really pay attention to. This slide here, you may at first blush say, well, is this really an important slide? It is, because this is essentially measuring change in household debt. And it's just over the last year. And what you can see from this slide is we saw an increase. We're seeing an increase in household debt. And why it's important is because this is essentially impacting the consumer. It's impacting all of us. We know that the consumer accounts for a majority of overall economic activity. So when we're out and about, spending money and doing things, that's really good for the markets and the economy. So if we're servicing more debt because we've taken on more debt, that's less money in our pockets to be spending in the economy. And so it is something to watch and to keep an eye on.
And I think this is this is one of the ones that I look at when I kind of consider consumer habits. You mentioned this is a big piece. It's 70% of our economy is driven by consumer spending. So you all going out and spending money on stuff is what, when you go get your hair cut, when you go buy a new car, 70% of our economy is coming from us directly. That's not including businesses. Businesses is roughly, what, another 10%? So when I look at this, the one thing that we can say is that consumers are still spending. We want to know how healthy the spending habits are, right? Because one of the concerns that we have to look out for is if consumers are spending out of debt and the cost of debt is increasing, which is higher interest rates, then we do have some things that could kind of say, okay, are there some cracks in the foundation that we just need to make sure we're being careful about? As we take a look at all of this, one, we know that prices around everything, inflation, have gone up. Cost of borrowing money has gone up. Wages, while they have gone up, they have not gone up as much as inflation. So you're not seeing what we call real wage growth necessarily, where wages keep up with inflation. Because of that, you're seeing people spending more money by borrowing. If we continue to see this type of a trend, that can start to get dangerous. It's just like in our personal lives. If our debt gets out of control and if our debt's expensive, it gets dangerous. And even as we take a look at the U.S. economy, we can kind of say the same type of thing, right? As a country right now, we've got $34 trillion in debt. So just to put that into perspective, and why I think it's important that we talk about things like this, $34 trillion in debt along with increasing interest rates just means that the debt as a country becomes more and more expensive. Now the good news is, as a country, we are a powerhouse of a country. We are innovative, we're growing, there's a lot of great things about the U.S. The one thing that could really hamper us would be high cost of debt. This is the #1 growing line item among the U.S. budget right now, which is debt service. By 2053, it's expected that just the interest payment on our debt as a country will be greater than what we're spending on Social Security, on Medicare, Medicaid, and defense combined. I bring that up to you, and this is a little bit off topic, but I bring this up to you because this is one of those reasons why so often as we're talking with our clients, it's so much about taxes and the impact of avoiding taxes while you can, or taking advantage of low tax rates while you can. And just a quick area of that is we are still under the tax code that came into play in 2017. And that tax code, whether you like the guy or hate the guy that did it, it is a beneficial tax code for tax planning. And it is set to expire at the end of 2025. So we've got about 1.5 years of what we would consider favorable tax planning time frame. And then we go back to the old tax code where tax brackets are going to be higher and so on and so forth. Bring this up because if we continue to have debt problems, or if we continue to have that be a growing line item on the budget, which is expected to be significant over time, there's only a couple of ways that we solve this problem, right? As a country, we either stop spending money, which isn't happening. We print more money, which has happened, but it hasn't really solved the problem. We've just spent more money as we printed. Or we begin to look at revenue sources for the U.S. government. And all of your smiling faces are revenue sources for the U.S. government, which means at some point, taxation is realistic, and we just have to have those good conversations. So again, I throw that out there. That's what I see when I look at this. This is one of those things that just as Americans are spending out of debt, the U.S. is spending out of debt, and there are consequences if you don't keep it under control.
There's also incentive, I mean, to that point, there's incentive for, you think about from the government's perspective, there's some incentive to drop rates, right? And I think that's why we're starting to see that forecast for this year as well, because of the debt service and the impact that that's going to have. All right, let's change gears just a little bit. Let's talk about the election. So going into the year, you know, for myself personally, I go into this year, I'm thinking, oh, we got another election. You know, let's get ready for all that's going to entail. And you guys may be thinking the same thing. But I wanted to share on these couple slides just some interesting data and information that I think just gives us, hopefully gives us some peace of mind as we think about the election and what that impact could be. So there's a lot of data on this slide, but what I find so impactful is it's telling us, okay, based on the S&P and average annual performance, how do we typically see that performance panning out based on different outcomes? So if we get a Democratic president, and I want to say, I have a little hard time thinking, so, you know, Republican Congress, I'll just look at it here. If we get a Democratic president, Republican Congress, the average annual return in that scenario has been almost 19%. Not bad. Next down the line, on the flip side, we look at a Republican president and a split Congress. That has resulted, you know, in the last 75 years or so, almost 18% return. You're probably looking at the worst scenario here, which is not awful, but you know, 7.5% if we were to see a Republican president with a Democratic Congress. So, you know, I like this to look at this. I think this is interesting, just telling us, okay, well, depending on what could happen towards the end of this year, it's maybe not as bad as we thought it could be. And then this next slide, this is also, I think, a slide that is, to me, is very interesting. This is pointing a little bit to what I was talking about earlier with when we look at 4-year presidential cycles, the year of a presidential election tends to, historically speaking, has been about the second best from an average annual return perspective in the S&P. And so we're looking at this data since, 1928, and we can see that the year of a presidential election, all election years, the average return has been almost 12%, which is not bad. If we were to break it down a little bit further, we can see if it was Republican that was elected, 15%, Democrat, not quite as good, but almost 9%. Now, I'm not saying, and I think you guys can see that the column here on the right, certainly not saying that we never get negative years in the year of a presidential election, because we can see that we have had some. But what this data is telling us is just on average what we tend to see based on those 4-year presidential cycles.
So Jacob, what you're saying is it doesn't matter who wins, we're
Exactly.
Just kidding, no commentary. Everyone has their own political views, but from a market perspective, we're historically going to be okay.
All right, last slide on the election. The one thing I'll mention on this slide is focusing on trend is quite a bit more important than focusing on the level. But if we look at 2024 and we say, okay, over the last 100+ years, we look at the cycles of these 4-year periods, history and the data tells us that, and we can see here on the slide, that we tend to get a lot of consolidation and weakness in the first half of the year. And that's really our base case scenario, which is supported by this. And a lot of times we tend to see rallies as we move into the second half of the year, which surprises, I think, a lot of people because it's not what you would expect. But in kind of those normal presidential cycles, a lot of the uncertainty is starting to subside as we get into or get closer to the election, and that history would tell us sometimes expect that rally.
Jacob, real quick, while you have this slide up there, you use the term consolidation. And we get that. I don't know if everybody else does. So show folks on here where consolidation is happening versus expansion.
Yeah.
And really just what that means, just to give a little bit.
Yeah, when I say consolidation, really I'm looking at the 2024 year, and I'm looking at really the first half of the year. You can see it's just kind of back and forth, right? It's going up, it's coming down, it's not really making any sort of trend. So that's what I view as consolidation, and then I think everybody can kind of see that obviously the second half of that year, that upward movement in trend tends to forecast some sort of rally. All right, so we are to the 2024 forecast. I start with this slide saying, take it with a big block of salt, right? Because we saw 2023 how badly or how poorly everyone handled it, or how they thought the market would end up. But what we're seeing here is, again, based on the group average, we're seeing that everyone is saying we're going to end the year at about 4,800 on the S&P. Now, just to put it into perspective, we're almost at 5,100 on the S&P right now. Goldman Sachs, a couple weeks ago, they adjusted their forecast up a little bit. I want to say they went to 5,200. But again, this to me points to our base case scenario, which is this first half of the year. We're not expecting a big run in the markets. I hope we're wrong, but are expecting some potential weakness, again, kind of this back and forth mindset of stock prices, but we could see a rally as we move forward into the second half of the year. As I wrap up my slide, my part of the day today, I want us to end on this slide. And I think this is a really, I really like this slide because this to me points to the benefit and the value of just a consistent, disciplined approach. And so what we're looking at here is we're saying, okay, on a 1-year period, a 3-year period, a 5-year, and 10-year, out of those periods, what has resulted in positive performance? So we can see in a 1-year period, about 73% of the outcomes have been positive. As we move further along in the 3, the 5, and the 10, we can see that the percentages of positive performance over time go up, which just again points to the idea of when we build an investment strategy or an investment portfolio, having that fundamental, consistent, disciplined approach is really what wins out over time. So, you know, I started the day today with the story about going up to New York, and when we were coming back down from our trip, I can't tell you how many times our GPS had us reroute. I know we all use GPS, but we use Waze specifically. I think it has a little AI built into it, but it tries to predict, you know, if it says, oh, there's traffic here, reroute, go somewhere else. If there's a wreck here or a cop, you know, be aware. And so we had to be okay and with adjustments, right, and being flexible. My wife and I, we love Starbucks, especially when we're traveling. So we had a couple times, you know, we pinpointed, okay, we're going to stop at this Starbucks in Pennsylvania, and inevitably, you know, Caden, you got a little fussy early on, and so we had to be flexible and adjust and change our course. We have to do the same thing in our investments in our portfolio. Again, I think the value of a consistent, disciplined approach can't be, you know, reiterated enough, but we also know that we're going to make adjustments, we're going to make changes, and plan accordingly.
So, real quick, I've got a funny Waze story, right? We talked serious, but you said that, I got to tell a funny story. And my dad might watch the video that we sent out. He's not here today, so he might kill me for this one. So you all know on Waze, you can change the voices, right? If you go in there. Well, my dad didn't know that. And he was going on a trip with my mom, and I changed it to British boy band. Right? And it's kind of like this British kind of like, you know, kind of almost goofy sound. So my dad was mad, and he was texting me. He's like, how do I turn this off? And I was like, Dad, I don't know. I'm not sure what's going on with your Waze. Anyhow, so he stopped to go to a restroom at a gas station. And he said, I walked into the restroom and I had my phone in my pocket. And it was a crowded restroom, you know, not a line, but there were plenty of folks in there. And he said, right as I walk in, all of a sudden, the Waze says, turn left. And he said, I have never been so embarrassed in my life because everyone just like looked and wondered, you know, why this guy was doing this fake British accent. So, anyhow, Dad, if you're watching, I apologize, but it was just a funny story. You mentioned Waze, and if you know anything about Chris at the office, Chris is definitely the one that chases squirrels. And if you've ever been in a meeting with me, you know, occasionally you'll see me looking in the window at a bird or a squirrel. pointing that out. So there's my way story. Now, all right, so we've got this, but let's talk a little bit about the impact of this on kind of portfolio decisions and what that looks like. We're talking about making adjustments in portfolios, kind of what the strategy is right now. You know, where you know, I guess we can say, where's the opportunity? But sometimes opportunity isn't as direct as making sure that we're following the right structure and strategy.
Yeah, I think the biggest thing that comes to my mind, I know you talk a lot about this, but I talked about the environment this year being not as good as last year from a growth perspective. So we're not expecting growth to be as good. We're actually expecting a declining growth environment. That type of an environment speaks to having what I consider to be quality in our portfolio. And quality can mean a couple different things, but from a stock perspective, I think of quality as in a company that pays dividends, that has strong balance sheets, good free cash flow, not a lot of debt on the books. Those are the types of companies, as we move into a declining growth environment, that we want to have investments in, because those tend to do better on a relative basis if we're in this type of environment than the high flyers. Like we talk about the Magnificent Seven last year. The Amazons, Microsoft, Meta, Google. Those all did splendid last year and really well from a growth perspective. We're expecting a shift. Those are great companies, and those are probably going to continue to do well as we move forward. But they are expensive right now because they went up in price so much. And so we've made some active decisions to try to reduce exposure to some of those big name companies that are, quite frankly, expensive right now, into more of a quality focus within our investments. And that's one of the, I think when you ask that question, that's what comes to my mind, just based on some of the changes we've made in portfolios.
I think that can be tough too, because obviously you hear about some of these companies that are they're exciting, right? NVIDIA is the one that we hear probably the most about on the news. I mean, that's one exciting company, phenomenal returns, and sometimes the expectation is, well, why aren't we all in NVIDIA? And the reason we're not all in NVIDIA is because we can all go back 20 years and we can think of companies like WorldCom, Enron, and companies like that. Not that NVIDIA is going to be in that world, but companies that just take this meteoric rise, but then also take a meteoric pullback in value. And I do think that those are some of the things that we have done.
We've got some NVIDIA exposure, just so you're aware. But to Chris's point, we're not going to just load up in a specific company like that. But it is good to have that exposure because it is a great company. But it is expensive right now as well.
Yeah, a little bit. I think the other thing too, just talk briefly about where opportunity might be in the bond market because of dropping interest rates and what that might look like in a portfolio, and why we might see some changes within portfolios according to that.
Yeah, so I think I'll break it down like this. So, and forgive me if you all understand this, but with fixed income or bonds, we know that they're inversely correlated to interest rates. So the way that I like to think about it, imagine a seesaw in the playground, and on one end you've got the price of bonds, on the other end you've got interest rates, and we know that it's going to do this. So we have been in an environment where the price of interest rates has been going up. The other side of that, bonds, obviously goes down because of the seesaw. We're now in an environment where we're expecting rates to fall and the price of bonds on the other end to be going up. So we're viewing that as an opportunity. One, I'll say, bonds are much more attractive today than they ever have been in the last 20 plus years, because we can actually get some cash flow, a decent amount of yield from bonds. But what's nice about the environment in a decreasing interest rate world is that we also would expect some price appreciation on the other side of that. So whereas you may say, well, okay, but if interest rates are coming down, that's not great moving forward for the price of bonds. You're right, it's not. But if we're able to allocate appropriately within a bond portfolio, lock in some of those coupon payments or those interest payments that are pretty good from a return perspective, and then also on the other side of that, be able to take advantage of the decreasing rate environment to get capital appreciation. We view that as an opportunity. So that may be a little bit more than you wanted to hear about bonds, but it is an environment where we're active in it. And you may have heard the term, riding the yield curve or going out on the long end of the curve. It just means that we want to increase some duration in our portfolio, which means that allows us to take further advantage of a decreasing rate environment to get some of the capital appreciation on the other side.
So for those of you that need that in regular English, which I think that was good, but we talked about headwinds and tailwinds, right? And the thing is, some of the headwinds that we talked about, specifically like some of the interest rate type of stuff, some of those headwinds could actually be a boost to the prices. So I always think of that. If we didn't have headwinds, and I'm going to speak out of turn because I'm not a pilot. We have somebody that knows how to fly and do pretty well. But if we didn't have headwinds, then we couldn't get lift. And sometimes those headwinds are necessary either for long term or there's other opportunities inside. And I think when I think of headwinds and tailwinds, not all tailwinds are going to be our friend, and not all headwinds are going to be our enemy. And I think right now what we have to do is we have to say, okay, potential for decreasing interest rates. People are going to say, oh shucks, my money market's not paying enough, or my CDs aren't paying enough. But there is some benefit in that, which is bonds will receive some bump up. And that's our job, is to find the opportunity inside that and not go all in, but say what's an appropriate amount for us to put.
Yeah, well, I mentioned this morning the team that we talk a lot about where we're at in the market every day. And right now, when we're in this pause environment where interest rates are with the Fed, we've had an interest rate hike last year, and now the Fed's paused rates, and we're expecting the next move in interest rates to be a decrease or a decline in rates. This is an opportune time, if you've got lazy cash sitting on the sideline, to say, okay, maybe it's time to start to inch into a conservative bond portfolio to take advantage of the decreasing interest rate environment. So there are different ways to look at it, there are different strategies, but that's one thing that comes to mind, and we talked about that this morning. So,
perfect. All right. So a couple of, before we open the ground up for questions, a couple of steps that we would point to you all to say, when we're in a relationship like this, the thing that we can't do is know everything that's going on in your world or in your life. The best thing that we can give is communication from all of you when things in your life change, good, bad, or indifferent. So number one, just keep us informed of anything that's changing. Part of Bob's job with us is making sure that we're changing and increasing our cadence. One thing many of you are going to start noticing and feeling from us is that we're having our client service team be more proactive and just reaching out, kind of what we consider check-in calls to make sure that this first area is taken care of more naturally from our side, so we can be a bit more proactive. But we do ask as we reach out to you, and if there's something that we need to know, if we've dropped the ball, if we're doing good, or if something's changed in your life, let us know about that, because we want to make sure that we can address that. As always, let us know about specific concerns that you might have. We may not always agree with your concerns, but our job is to oftentimes walk investors away from the ledge. There are times when, and as we go into an election year, it's going to get scary. There's going to be some things that go on that get us all nervous. The best thing that we can do is make sure that we're having intelligent conversations. The reason why I had Jacob speak so much today is I want you all to understand kind of the knowledge that Jacob brings to the table. And oftentimes, if you need to have that investment conversation, Jacob's going to be a great source for you to do that. And then finally, just making sure that your documents are up to date. Good reminder for all of us that every 5 years or so, we should be updating our documents. If you all need a referral to anybody legal-wise, we're happy to do that. We do have some software in-house as well that allows us to do some very general type of work. It can get a little bit more complex depending on your situation, but if you need some additional insight on that, we're happy to talk with you about that as well. Some things that we need to do and we plan on doing. Number one is just keeping you informed. One thing that we've committed to over the past few years is to try and be inboxes on a weekly basis, giving you market-based information, financial planning information with regularity. Events like this, as well as some other events we've got on the calendar around taxes and so on and so forth, are going to be coming up as well as our monthly Wealthologist Live that we conduct together. Something else that we're doing as well is we're increasing the regularity of our newsletter that goes out to you that reaches you in your inbox. You should, or in your mailbox, and you should be getting that as well fairly soon. Anyhow, we're trying to do a good job of communicating, but as always, communicate to us and let us know where we're hitting it out of the parks or where we might be missing. Managing your investments is our second thing. As you can tell, we're passionate about this. We may not always know every answer that exists, but we've got a great brain trust, and we've got a lot of experience between many members. We're continuing to deepen the team, and I think you're going to see that more and more as we go forward. And obviously, just like we talked about today, our job is to remain abreast about different economic issues and topics so you don't have to worry. Inevitably, there's going to be something that comes up on the TV that makes you worry. Reach out to us. We're always happy to talk about that. All right. What's our time? I think we've got maybe a little bit of time where we can take some questions, you think? So, oh, there we go.
What do you think about AI?
Oh, what do we?
Yeah.
I think AI is a structural trend that will take some time to actually see consistent, positive economic benefit from. But it is a trend that I think is here to stay, whether we like it or not. Now there are a lot of implications for AI, and there are some things that, quite frankly, scare me about, to be honest. But I think from a growth standpoint, it is going to impact the markets. I think it will have an impact on growth over time. I think this past year, AI was such a hot topic, and it definitely drove, in my opinion, some of the performance of the market. I think some of that was forward-looking, saying, oh, this is a big deal and it's going to be a big deal, but we're not quite seeing the actual impact from most companies in the bottom line quite yet, but I do think we're going to see that over time. So as we move, into further into this decade, I do think it's going to be a trend that continues.
In our portfolios?
I'm sorry?
In our portfolios?
In our portfolios and in the overall market.
Meaning there is some exposure. I didn't know if that was made correct.
Yes. Yeah, we do have exposure to AI because if you think about it, just about every company wants to be on that AI trend. Microsoft, NVIDIA, Google, any tech company is going to have either direct AI exposure or indirect. So it's definitely something we have in our strategies. We may have more of it over time, but we'll just have to see how that plays out.
And I do, your question also was good investment, bad investment. I think to your point, it's a tool that will be used, and it's going to be a game changer, right? So I think to ignore AI from an investment standpoint is missing, which is why we put it in the portfolios. The issue is it's very early on to know which horse wins. And if you go back 100 some odd years and you look at like car companies, there were over 100 car companies that existed when cars really, I was going to say took flight, but that's not the right word. They put the wheels to the road. But what happened is you saw massive consolidation. But where the opportunity then came were the companies that supported car companies, Goodyear, gasoline companies, so on and so forth. So those are the things that I think as we really look at AI, you're going to look at the efficiencies and how that does impact the company's bottom lines. But from an investment standpoint, I think you're going to have the AI type stuff and then the ancillary things when people discover really how to use AI in a meaningful manner. I had lunch yesterday with a company that they're starting to utilize AI in just a really unique software manner. And it was one of those things where not even on my radar that AI could be used in this specific manner, but it was what this company is driving towards. And I think that's where the innovation is going to be really, really something special. From an investment standpoint, we're going to be within that, but we're not going to be irresponsible, right? The last thing you want is for us to be so excited about AI, and then we have to make apologies because we overdid.
Is there any point talking about perception? I talk to people who think the economy is in the tank right now. It really isn't. It's not just one person, but lots of people. I assume that's important.
Perception is very important, and I think to that point, I think when you say perception, I kind of think about how the market is also very forward-looking. So the perception from market participants is that it's not about where we're at right now, but what we talked about in some of these slides. Where do we think GDP growth is going to go? Where do we think the job market is going to go? Because quite frankly, the markets are forward-looking. So if you think back to that first slide we had up of the chart of the S&P, we saw a nice uptick in the market towards the end of last year, but the Fed, said, oh, we're going to start looking to cut interest rates in the middle of December of last year. But the market had already started to move up. So the perception is very important. I think it's important to look at data and statistics, because that really is what helps us determine, weed out the noise versus what's actually fundamentally true, and what can we kind of stake an investment decision on or make a change. But yeah, it's important. It's an open-ended question. I don't know if you have anything else to say about that. It's a good question.
I think this is a case where oftentimes too the importance is separating market perception versus economic perception. So the market is doing well. Did well last year. Economic perception, though, is oftentimes where I think people kind of are a little bit down. And it's when people do look at things like debt or ancillary things like that. So I think we have to separate the two and say, sometimes I think the market gets thrown into that, and people say, oh, the market's not good. No, the market's done pretty well. There are some economic concerns that then can impact the market. And I think that might be why we're hearing people, but we also have to keep in mind that, a lot of that's driven by the media, and what leads, right? So, we used to have, before dinner, we might have the TV on or something. And I finally said, man, we just got to turn this off, because the amount of horrific stories that are consistently on the TV, specifically like local news, you would think that all that happened was somebody walked around Charlotte killing people. And I mean, I've never been killed here. So I feel pretty good. Doesn't mean that doesn't happen. But it is perception. And I think we've got to be careful what we're feeding ourselves. And that's why when we're looking at what we talked about today, we're trying to give a well-rounded perspective of saying, look, there's some stuff we've got to watch out for. It's stuff that we're also excited about, some of those tailwinds. And we're going to work within that.
Well, I was going to say, even the perception, if we think back to that slide of at the end of 2022, the perception on the speedometers, it was all mostly red, so perception was not good at all at that point in time. But now we know what the market did last year. So you do have to be careful.
And again, that slide was economic.
Yes.
Whereas the market, we got to decouple the market and the economy, because they're two different beasts.
As more questions are coming up, can you please repeat them?
Oh, yeah. So he said, well, he actually did say, as more questions are coming up, could you please repeat them? So I'm repeating your question, but that's perfect. Any other questions?
You showed that big chart about all the other presidential years, how the market didn't do, but this year is so crazy, so different from all other years. I myself, I'm kind of terrified either way it goes. Are we prepared for what's going to happen in November?
So the question was around, we looked at the past history of presidential elections and so on and so forth, and that this current situation feels different, and it feels scary, and are we prepared? And I don't know if you want to talk a little bit about that. I mean, the one thing that I will say is, and we always joke about this internally, this time's always different, right? Because we're in the middle of it. If we go back to 2008, we would have sat there and said, this time is different. This is 2008, this credit crisis is going to kill the world. And it felt that way. I mean, I remember just being scared to death with everything going on. And now we look back at 2008, we're like, oh my gosh, that was just a blip. Let's go back 4 years when we were all inside of our homes right around this time. We were getting ready to go into lockdown. And we could all agree that that time was different. But here we are 4 years later in a scenario like this. That's not to minimize. And that's not to say that it doesn't feel different. But what I will say is when we're in the heat of the moment, it feels really different. There are a lot of things going on with this. And I'm still a believer that the two folks that are there now, they might not actually be our candidates. We don't know. But yes, as we go through, we're continuously monitoring, we're continuously looking at. It doesn't mean that we make every bet correctly when it comes to the markets and management, but we also are working with a very diversified strategy to make sure that we're not putting all the chips on one success in one area versus success in another. Jacob, you have any other?
I think you summed that up very well. That was exactly my thought, is the what's the four most dangerous words are this time it's different. So, and I don't say that to minimize the concern, because it's a valid concern. But I think the points you made were spot on. And I think I find relief or comfort in the data and the statistics, to be quite honest with you. If we look at the environments of a Democratic president, Republican president, and then what's the makeup of Congress, we can see, there are times when the markets don't always do well, but that's life. But when we look at those averages, they actually aren't as bad as what we thought. So I think it's just important to be careful that we're not putting out there that this time it's completely different, but resting on fundamental time-tested strategies and principles when it comes to that.
And I do, and to your point, looking back at the data and looking back how far that went, that's what does give me comfort, because we're talking about in that data we had major world. So we had different conflicts. We had we've always had political stuff going on. I think the key is that from our side we got to be nimble. We got to look for opportunity. But if I will tell you, if you have any specific concerns that you want to dig into, or if anybody does, let's talk about those and make sure that we really dig into those. If nothing else, to put a little bit of perspective behind it as to what we're doing behind the scenes to address that. Yes?
With the recent decision by the SEC regarding crypto, what's your thoughts on that? Do we have any?
You can make the argument that there's always an indirect exposure from the crypto question.
Oh,
sorry.
Good point.
So the recent law that was passed around crypto, what's our thoughts on it? Are there any impact of that from our investment portfolios? Are we exposed to crypto? So we're not exposed to crypto directly. I mean, you could make the argument that indirectly, there's exposure to some of those industries and sectors. I think more so from a tech perspective, because a lot of the tech companies tend to dabble, I think, in the crypto space a little bit more. It'll be interesting to see how the change is interpreted by the markets. And I think from a crypto standpoint, I think it's important to delineate between, and again, I don't want to go down a rabbit hole, but Bitcoin, and then there's a lot of other crypto out there. So I think you have to almost delineate between those. Bitcoin, we just have a lot of spot Bitcoin ETFs approved, and I think that's probably bullish for Bitcoin moving forward just because of fund flows that are going to be coming into those ETFs. But no, we don't have any direct exposure to it.
I will say one thing with that, and again, the SEC, while they have opened that up, it's still one of those areas that there's just some red flags around that where there's some excitement. Personally, I own some direct, so that's kind of my recommendation. If that's an area that you're kind of excited about, owning some direct crypto that allows you to kind of be on the spot, because I think that's where some of the opportunity is going to come, is to be a bit more reactive, as opposed to within our portfolios, we're going to look at a little bit more of a longer term play, and we really want to see how that pans out a little bit. I do think those inflows of money, though, should drive that forward. Any other questions?
What is your opinion on the electric cars? The public is not buying them. What is the strategy on that?
Yes.
For the coming year?
So the question is, what is the strategy on electric cars? That the public's not buying them, and kind of demands going down a little bit. I mean, just as an aside, I mean, I think there's two factors that you have to look at, right? You've got the government pushing that, and we've seen that the government is saying, hey, this is an area that we want to push forward. But you also have to have consumers that want it. And I do think that's a great thing about like our economy, right? Which is at the end of the day, if somebody can build something, there's no reason why Tesla should have been successful given all the headwinds that they had. But Tesla did very, very well. And the reason is they built something that the people want. I think that's what car companies, quite frankly, have to get to with this, is they have to start building, people will buy things when they want it. It's just they've got to create some better efficiency. Right now, electric cars are still not convenient. Now, we do have, Andrew drives an electric car, and Andrew, will you ever go back to a gas car? Never.
I've got one too, I love it.
I've got a gigantic truck that guzzles gas like you would not believe. And I love my truck. And the thing is, would I consider an electric truck? I would, but it has to be something different. It can't be that cyber truck that Tesla. You have any perspective?
Yeah, I think you hit the nail on the head. I think just the infrastructure right now, is, in my opinion, it's not convenient yet to own an electric car. I think, Andrew, you may disagree with me. But when I think about how just the infrastructure to charge it, how long it takes to charge it. If I'm going on a long trip, I've got to plan differently. I can't take it to upstate New York, right? It would take us a week to get up there to have to be charging. So I think some of that plays in probably to the industry as a whole, just the demand. But I do think that is a trend that we're probably heading towards, and as infrastructure and the ability to service that improves over time, I would expect it to be a trend. I don't think that trend's going away. And then there's a lot of, to Chris's point about ancillary impact, there's a lot of ancillary impact from that when you think about batteries, and lithium, and just all the things that are required to make those cars run.
And I think that's the thing that I look at. I think now that we are far enough into the electric cars, I think now we're starting to see, we're getting out of the honeymoon phase, right? And as we get out of the honeymoon phase, we're starting to realize, oh, these may not be as clean all around as initially thought. And I think that for lack of a better term, puts the brakes on things a little bit, where folks say, wow, what is the economic, or what is the environmental impact on something like that? Andrew, have you had to buy a new battery yet for your car? Okay, but when you do buy it, how much are they?
I've heard 13 to 15,000.
Which, again, in defense of my gas guzzling truck, that I do put a lot of gas in and I pay that, but it's little by little. The thought of having a $15,000 battery is, that's a gut check. And again, I think people are starting to see that and experience that, and then what happens to that old battery. Now, again, people that drive an electric, they love electric. And if you've ever driven one, they are really unique and fun. It's just, they've got to build the infrastructure, they've got to truly be a bit more green, I think, and they just take off. It's just not happening.
Well, they're great for a town car.
Yeah, there you go. Any other questions? All right, Bob, you coming up to wrap us up?